Do you believe the long-awaited positive news for Tesla shares will arrive soon? Without a doubt, Tesla has had a difficult year and is just now starting to turn things around. Is it, however, truly happening at last? Be sure not to overlook this. Some believe the company could have a significant upside in the future, even though Tesla's price was significantly lower last year. Investment company Morgan Stanley is among the many experts who anticipate major value growth in Tesla's low stock price. Early in December, according to a report from Teslarati, Morgan Stanley named Tesla one of its top picks for 2023, citing the company's strong position in the face of a downturn market and growing competition. Additionally, the company held onto its $330 price estimate for Tesla stock, although some other analysts had lowered their own targets. In a note to clients, Morgan Stanley stated, "We believe Tesla's gap to competition can widen, even though we see 2023 as a challenging year for the EV market." In fact, despite recent unrest and concerns about Elon Musk's concentration, Morgan Stanley is still positive on Tesla shares. Longtime supporter of Tesla, Adam Jonas lowered his price estimate for the stock to $250 from $330 in a recent client note. Even with the admission of guilt, his revised estimate still implies a 122% increase from the company's current share price of just under $125 in early January. Based on statistics from TipRanks, Jonas's goal is nearly exactly the same as the street's average target, which is $251.48, and is expected to gain 104% in the upcoming months. The consensus rating for the stock is a moderate buy with 20 buys, 9 holds, and 2 sells. Two key factors, according to Jonas, will contribute to a sustained optimism. First, Tesla will maintain its current advantage over rivals in the electric vehicle market. Second, the Inflation Reduction legislation will help the company. Regarding Tesla's more than 65% decline in 2022, which included a 40% decline in December alone, Jonas refrained from assigning blame to CEO Elon Musk's obsession with Twitter, which an increasing number of detractors have identified as a significant cause of the company's losses. Rather, he blamed a variety of technical issues, including the first supply-side oversupply imbalance since the COVID-19 epidemic. According to Jonas, the recent 2-year situation of supply being less than demand will significantly reverse to supply exceeding demand. Relative winners in this climate, in our opinion, can be those who can demonstrate scale and cost leadership across the whole value chain from manufacturing to upstream material supply, and who are self-funded and not dependent on outside capital backing. He went on, there are obstacles to overcome because of the worsening macro environment, record high unfavorability, and escalating competitiveness. However, we do think that Tesla will continue to pull ahead of the competitors in the EV race as it takes use of its cost and scale advantages. However, some investors believe that Tesla is in a strong position for the coming year, despite the fact that other investors are concerned about the company's most recent error adding to a string of negative headlines. Several investors were disappointed to see that Tesla's numbers fell short of Wall Street's expectation of 431,117 deliveries for the period, and that vehicle supply again exceeded demand when the company announced in early January that it was producing 439,701 vehicles and delivering 278 in the fourth quarter of 2022. Some who closely follow the company, meanwhile, are less concerned about all of this. Adam Jonas of Morgan Stanley, for example, continued to have faith in the EV manufacturer. As previously said, significant changes occurred in the global electric car industry last week. Previously, there was a serious shortage of supply, but now the trend is shifting, possibly leading to an abundance of supply, according to Morgan Stanley analyst. Adam Jonas, 2023 will be a year when supply chain management and manufacturing cost execution will further set the winners apart from the competitors and result in more reasonably priced electric vehicle prices that will enable further market penetration. Both are going to be necessary when expectations are negatively reset. Testing capital self-sufficiency is another option. In fact, Jonas believes that over the next few years, the rate of exchange of EV penetration could potentially prove to be something of a letdown as buyers, regulators, and investors weigh the hidden costs associated with shifting from an EV supply chain dominated by China to a market where many players have yet to demonstrate the viability of the business model. All of this lead-up concludes, according to Jonas, with one business being in a better position than the rest to lead the EV market in our coverage. We think Tesla is in a unique position to drive the cost and engineering advancements that are still needed to fully realize the EV economy's promise. In the near future, investors should prepare for a significant deflation in the EV market and a negative reset to margin expectations. According to Jonas, a floor in the earnings must be reached, even though Tesla may trade in an erratic, sawtooth-like range for some time until investors feel more comfortable with the floor in the stock's price. The Morgan Stanley stance, which follows the company's initial semi-deliveries to PepsiCo and precedes Tesla's intentions to start building the Cybertruck in 2023, is seen as cautious optimism. According to Musk, Tesla intends to reveal the location of a second factory by the end of the year. According to current rumors, this factory will be presented in Mexico in the early months of 2023. Tesla is also continuing to increase output at its new gigafactories in Berlin and Texas, the latter of which last month added an additional shift to its timetable. It might be a stock to keep an eye on in the coming year with new items and growth ahead. Not just Morgan Stanley is still optimistic about Tesla's future. Goldman Sachs kept its buy recommendation and reiterated its $333 price target for Tesla shares, despite the fact that it had already reached its lowest point in 2022. Moreover, market analysts at The Motley Fool and Forbes have consistently reaffirmed that Tesla stock's solid fundamentals would probably drive it higher in the upcoming year. Furthermore, despite Musk's company's performance. Falling short of expectations, an analyst from Deutsche Bank noted in a note at the beginning of January that both production and deliveries marked all-time highs. In total, the company delivered 1.3 million cars in 2022. Because of this, Deutsche Bank claims that despite obstacles like supply chain limitations, macroeconomic concerns, and COVID lockdowns in China, Tesla's performance is strong and that the company is still in the greatest position for growth in 2023. We expect challenging headlines around demand softening and associated price cuts to continue, according to Deutsche Bank, but the company remains best positioned to weather the current macroeconomic conditions, leveraging price to support volume growth while using various cost levers to protect margins. Tesla is among one of the best positioned companies in our coverage to weather weakening consumer conditions, said the analyst. Consider the multiple levers Tesla has in its possession to boost growth while protecting margin in 2023. Garrett Nelson, a vice president and senior equity analyst at CFRA Research, reaffirmed his strong buy recommendation for Tesla shares following a challenging year for the stocks of EV manufacturers, including Lucid, Rivian, and Tesla. Nelson declared in a research note, "We are bullish on Tesla in 2023. Nelson stated that when more affordable Model 3 and Model Y models become available, he anticipates a possible stock buyback and momentum. For the federal EV tax credit of $7,500, Nelson anticipates that as Tesla continues to scale up manufacturing in Austin, Texas, and Berlin, it will likewise reach new record high numbers. Nonetheless, some analysts believe that there is still a chance for the tech stocks to decline, which makes investors cautious. The fragility of the present bear market, which has been exacerbated by the U.S. Federal Reserve's decision to raise interest rates in an effort to fight inflation, is another reason weighing on stocks generally. Given this, analyst Dan Ives of Wedbush Securities has expressed his concerns about Tesla in recent weeks in a public manner. In fact, he stated the outcomes are suggestive in this weaker macro environment. Tesla is still growing despite the automaker's difficulties with supply and demand. Overall, these data show that the company is still early in a significant growth cycle and is expanding quickly on the EV front. Ives stated in a note. However, Tesla is held to a higher standard, and a miss is a miss, and the bulls are not popping champagne on these numbers. Still, Wedbush continues to see Tesla as an outperformer. These numbers could have been worse in the eyes of the street, Ives stated. That said, the Cinderella ride is over for Tesla. Besides, it's impossible to forecast what the price of Tesla stock will do in the upcoming months. Elon Musk, the CEO of Tesla, and a number of analysts have even dubbed the stock overblown at times, and in recent months, pessimistic market expectations have been the norm on Wall Street. On the other hand, long-term investors who already own the company and intend to ride out the recession may be in for a treat. Although some bulls draw attention to the low buy-in price of Tesla shares, many remain optimistic about the EV leader's stock recovering in the new year. Even while it probably won't happen right away, many analysts are still optimistic about the business. For more news, subscribe to Tesla Stock.